Greetings traders, my name is Timothy Hedberg. I'm a professional trader since 12 years back, and today I'm bringing you this week's market report for week number 22 in collaboration with IMGFX, the People's Broker. So let's jump right into it. Before we do, let me just remind you all that this is not an advice to buy or sell anything. It's purely here for educational content. So if you want to pause the screen and look through the disclaimer, you can do that. But to sum it up easily for you, always do your own research, always do your own analysis, never trade on just what somebody else says. I hope that this market report will help you navigate the upcoming week a little bit better by using the knowledge and experience that I have of the markets. So the agenda for today is that, as always, we will start with the economical calendar with looking at the events for next week. Then we'll take a look at market sentiment, the current and potential shifts to look for. We'll talk about last week's calls that were almost a complete home run with a 100% hit rate, which is very good. We'll talk a little about Bitcoin that is still stuck in its air pocket. We'll talk about gold, where support and the US dollar is hinting at further upside. We'll end off by talking about three specific trade setups where we have dollar yen, euro dollar, and euro pound, where we are looking at shorts to get going in dollar yen as it's breaking its structuring in connection to the US dollar, losing some ground. And then we'll talk about euro dollar, where there is a scope for further recovery, or depending on how price action plays out, it might be time to short. And then we'll talk about euro pound, where we have a long-term hold trade. So if we just start with the economical calendar for next week, you will see that we start off pretty slow on Monday. We have a bank holiday in the United States, so expect liquidity to be a little bit thinner than usual. Tuesday, once again, very, very thin. Not much at all looking at the economical calendar. GDP quarter on quarter for the Australian dollar on Wednesday morning, early morning. Of course, a good strong reading here could see the Australian dollar pick up some momentum, but generally speaking, it's these kind of figures needs to deviate quite a lot from the expected figures, but it also it's tricky because it depends on what the market is focusing on, and generally speaking, the market isn't focusing primarily on the Australian dollar at this point in time. Then we get sort of a little preview of what's to come later in the week with the non-farm employment on Friday, the so-called jobs report. So we kick that off with the JOLTS job openings, which once again isn't going to be super market moving, but if it deviates a lot from the expected figure or previous month's figures, then you can expect that to start creating some expectations for the big Friday job report. Same goes for ISM. It's quite a big release in terms of how the economy is doing, and also how the inflationary pressures are. So also this can be market moving depending on what the figure actually comes out at. And obviously we have rate statement for the Canadian dollar, which can move the market, because I've said it many times before, rate statements are pretty much the biggest data releases that we can have for a currency, so very, very important to keep an eye out for, especially if you have exposure in the CAD. Expected is a 0.5 hike. Then we go into Thursday. I will personally keep a little bit eye on the Spanish unemployment change, because Spain has had some pretty strong inflationary pressures. So it's interesting to see if this starts spilling over into the rest of the economy. Pretty much might see some thinner trading with bank holiday in Italy, and most importantly the GDP, but yeah, not that significant, as it's not the complete Eurozone or it's not the complete United States. Then you have the ADP non-farm employment change, which is considered a little bit of a preview for the big job reports on Friday. It's the same thing here, like I spoke about earlier. If this deviates a lot from the expected figures, then that will not necessarily move the market by itself, but it will create a expectation for the Friday jobs report. So important to keep an eye out for that, because that will of course affect what kind of expectations the market is entering the last day of the week, Friday, and that jobs report with, where we have the jobs report, unemployment rate, the actual non-farm number, and average hourly earnings. Now, I've said this before, the jobs report is not just one-sided. You can't just look at a non-farm figure. If the non-farm figure deviates a lot, like if it's 50% lower or 50% higher than the expected, then yes, the market can be very focused on just that figure. But otherwise, you need to look at all the components of the market of the jobs report. But especially average hourly earnings, I think will be a big one, because as we have this inflation issue going on, prices of everything is going up rapidly, especially in the United States. And if the cost of living is increasing so much, it will become a huge problem if the average hourly earnings can't actually keep up with that. So for the US dollar to do well, we really want to see a stronger figure here, but we'll have to see. So, the market sentiment at this point in time, if we take a look at the VIX, like we like to do, we can see that we are still at somewhat elevated levels, but we have broken down. We have actually broken through the 100-day moving average. So, this comes from the market, entered a actual bear market. But all bear markets, you get a temporary a bull run inside of the actual bear market. So it's expected, seeing the VIX going down a little bit. So if we take a look at the SPX, the S&P 500 in the United States, this has not played out as I was anticipating, with the whole highlighted historical correlation here, that when the S&P generally breaks its 100-day weekly moving average, it moves all the way down to the 200 weekly moving average inside a couple of weeks. We haven't really gotten that. Instead, we got this big spike up. And of course, we are in somewhat different territories in terms of economics these days after COVID and everything that's going on right now. So it's a little bit expected seeing markets move in a little bit of a different way than what we're usually used to. So would I buy the S&P at this level? No, I would not. Would I sell the S&P at this level? No, I would not. My somewhat skewed bias would be that we make a squeeze a little bit higher. Do we make it all the way up to the 100-day moving average? I wouldn't necessarily think so. I think we're going to run into some issues earlier than that. We are at support turned resistance right now, so we'll see how this plays out. In either way, I wouldn't be surprised if we see this bounce extending a little bit into this week. And if we do so, that would obviously also see the VIX move down towards the 200-day moving average too. So it kind of looks the same, especially if we take a look at the US dollar, which is also a good indication of risk, as it's the world's reserve currency. And as you can see on the daily chart, I've spoken about this before, we have been quite overbought ever since we broke out of the consolidation. So any type of pullback more into the 100-day moving average is completely very likely and not weird in any way. Could we see us move all the way down to 50 fib? Of course we could. So I think there's still room for the US dollar to move lower also, to at least maybe these regions around here. If it doesn't go too fast, this could very well coincide with the 100-day moving average pushing up, the fibs coming into play, everything. So everything pretty much starting this week point at a further risk rally, a further bounce in risk. And you know, I've spoken about this in many market reports so far, that when there is always a risk that the market is so hungry for positive news that it overreacts on positive news, and that's a little bit what we're seeing right now. So I wouldn't necessarily buy into the S&P at these levels. I think maybe the DAX is more interesting from that point of view, but we're not here to talk about buying or selling stock indices. The content of what I'm saying is that I think we could see this risk bounce continuing a little bit into the week, pretty much. So if we take a look at last week, we spoke about gold, which played out very nicely. I highlighted this support zone here, and we got that. We haven't actually reached my target of 1880 around that area yet, but it's looking very nice. You can see these rejections that we've gotten both of the actual 200-day moving average, but also this kind of support zone that I was highlighting last week. So if you combine that with what the US dollar has done, I think this is a good further push to the upside. But generally speaking, we had a good long trade of support here last week, so that call was very nice. We also looked last week at dollar yen. Now this is one that didn't really get going. We were looking for a break of this structure lower. We peaked below it but couldn't close below it. So I'm already in this trade with a small drawdown because I still think this can get going. But so if you took the dollar yen trade, it's neither profit nor loss at this point in time. It's just a small floating loss, and I think we can get some movement on that. Lastly, we talked about silver. That was even more interesting than gold. So although we couldn't really get a daily close above this highlighted level right here, we are getting this sort of slightly skewed head and shoulder pattern. We are getting very bullish price action into these levels. I think silver has a good run to the upside. If you took the trade last week, then obviously you would have made some good money on it in the beginning of the week. You would have been in profit at this point in time. So that's it for last week. We had almost close to a home run if just dollar yen could have gotten going a little bit more too. Hopefully it does now. So if you look at this week, if we look at Bitcoin against the US dollar, as I mentioned, we are still stuck in this little bit of an air pocket down here. We are consolidating quite tightly. So we are coming up to the adaptive moving average. Let's see if we can take that to the upside. Either way, we are a little bit oversold on the daily, so any type of push into this previous support zone now acting resistance could very well be the case here, especially as Bitcoin is just a leveraged risk trade at these days. So if we can see this actually move back to the upside in contrast to the S&P gaining some ground, in contrast to the US dollar losing some ground, in contrast to risk picking up a little bit, I wouldn't mind seeing Bitcoin a little bit higher for this week, as long as risk keeps on going. But I don't really have a trade on it at this point in time. I would have to see how it behaves upwards to these levels right here. Gold, as I highlighted earlier, I still have my upside target that I want to get hit on that. So I'm looking at 80.80 to reach in the beginning, and depending on price action around here, I think we could move even higher, maybe even towards the 1913, 1915 area, depending on price action. But I think there's good upside still in gold, as long as this support zone right here keeps on holding. So into the trade setups, if we look at dollar yen, this trade is still on for this week. We are looking for a breaking structure. We are seeing hints in both the risk pickup and the US dollar with scope to lose some more ground. So with all of that said, I think there's a really strong case for dollar yen to keep on falling this week. We still just haven't really gotten it. So, you know, I don't mind being in this short trade. That's a risk that I actually like having, because I see the odds for it to move downwards is much higher than for it to move upwards, especially looking at intermarket analysis, looking at all these different themes that I just spoke about. So from that point of view, I think this can get some legs to the downside. Is it guaranteed? No, of course not. Nothing is guaranteed in terms of trading, but you just want to play the probabilities, and I think this is a high probability trade to the downside. So short dollar yen, I think, is still a good go. If you aren't in the trade already, I would personally wait for a daily close below this region here, or maybe below the latest wicks at least, so that we just slightly in profit on the trade that I have highlighted here. Next up, euro dollar. So euro dollar hit my projected price from last week. I didn't speak about this in last market report, I think, but I spoke about this with my own traders that I educate. So we have hit that level. Now it comes down to seeing how price action actually moves here. So I highlighted this trade for my traders last week. Could have been a pretty awesome trade. I mean, almost 6-1 in terms of risk reward. So we are there now. Now we have to see, will we continue higher? So depending on price action, will we actually push higher into this level, or will we start pulling back, and is the actual pullback over? Not necessarily as once again, intermarket analysis, S&P, risk, US dollar. I think my preferred scenario here would be to look for euro dollar to break higher up into these regions, and maybe even further into the 100-day moving average. But as you obviously can see, around these levels right here, we start running into some cluster resistances. So I don't see euro dollar having that in it right now to start just continuing breaking through those levels. But a little bit of a further rally could very well be on the books. So depending on price action over here, I think a long trade doesn't really get this a 1-to-1 risk reward. So on the higher time frames, you would have to go on a lower time frame and find a momentum trigger. If so, it could be a good long trade just for the week to the upside. And if we can't really overtake this area right here, and we start seeing the US dollar turn the other way, and we start seeing risk turn the other way, then we have a great short trade to the downside. Next up, we have euro pound, and euro pound is, like I said, a trade that we have a long-term hold. So I highlighted this trade a couple of market reports ago. So if you have it since then it's a great trade, obviously. But it's still very valid, because if you in these days, it's kind of tricky having dollar support, because the dollar can change direction very rapidly with the current macro environment. So if you want to move away from that, but you want to have a correlation to equity markets, I would look, and to risk markets, I would personally look at euro pound. So with that said, I think euro pound still has a good amount of steam in it to run to the upside. I think as long as we have these risks of stagflation in the UK, I think the Eurozone is the economy that has the brightest future in terms of recovering. So even with the Russia-Ukraine conflict. So I would say this trade is still valid. Getting it in at these levels are still valid. Looking for this to push to the upside, to the low, to the previous highs, and watching how it behaves there. If this is the start of a new bear trend, we'll have to see. I mean, are we going to see something like this where it starts moving downwards? So you could target this trend line to begin with, but my preferred would be to see it moving somewhere upwards into this region and then turning lower. So that's more of a long-term trade. You would look to hold it through the summer, etc. So yeah, that's it for me this time. Let's see if we can get another high profit week. I hope you guys find this useful. If you like the video, please leave a like on the video. If you have something that you want me to talk about in the next video, leave a comment and we'll try to do that. In the meantime, I wish you all a safe and profitable week. Let's look for green numbers. Take care, guys.